All right, we're on to Module 6, and Module 6 really we're going to be talking about two of the ways that companies finance their operations, and that's debt and equity. Debt, of course, is something that you owe, you borrow money. Equity means that you have sold shares to your business. If you're a debt holder, then basically you get interest payments and then your principal back at the end of the debt. If you're an equity owner, you probably get dividends and you basically own the company, or you're one of the owners of the company. And so you can sell your shares. You can sell debt as well. So let's look at the introduction here. Our learning objective is to describe the nature of bonds, illustrate the characteristics of stock, classes of stock, and entries for issuing stock, and then account for cash dividends and stock dividends. Bonds are, again, debt obligations. You can buy a treasury bond. A lot of these bonds come in increments of $1,000. So you're basically loaning someone $1,000. If you loan them $10,000, then you buy 10 bonds. U.S. government treasuries are the risk-free rate because supposedly everyone feels that if you borrow money from the U.S. government, you're going to get paid. That has been the case for as long as we know, but we do have to be concerned with the fact that the budget has increased significantly over the last few years, and our creditworthiness may be declining. Hopefully, we'll get that straightened out. What do we have to do this week? Well, you're going to have your normal problem set, and then you're going to have the comprehensive problem. This is something you've been working on, and hopefully, you've worked on that and you've corrected it because you're going to need that. You need to be able to pull that up to complete this week's assignment. Resources, we've got the chapters, of course. You've got a couple of videos here. Liabilities, you'll find out about the different liabilities, and then you'll look at the present value of bonds. Now, how do you value a bond? Well, you basically look at the cash flow. And let's say that I have a bond and I'm going to issue a $1,000 bond at 4%. So what I'm saying is that if I make an annual payment, I'm going to pay you $40, and let's say it's a 5-year bond, and so I'm going to pay you $40 each year, and at the end of the 5 years, I'm going to give you your $40 and your $1,000 back. When a company issues debt, they have to go through the Securities and Exchange Commission if they're a public company. That normally takes 2 or 3 months. It's unlikely that the rate that you put on your bond is going to be the same rate when you actually sell the bonds. Bond prices change by the minute. And so to still sell those, you may have to discount or you may get a premium. In the case of an interest rate that the market rate at the time you're selling, if it's higher than your rate, well, no one's going to want to invest in your bonds unless you sell it at a discount. How is that discount determined? Well, again, you take that cash flow, $40 every year plus $1,000 at the end of 5 years, and you discount it at 5%. And so instead of selling it for 1,000, you might sell it for $970 or something like that. But it's all mathematically figured out. And so, again, if the market rate of interest is higher than your rate, you're going to have to sell it at a discount. If your rate is higher than the market rate, then you get a premium. So you'll get more than $1,000. This present value of bonds will give you an overview of how to determine that. You can use Excel. You can use a financial calculator. I have a 12 HP 12C that I've had for, gosh, 30 years now, but it still works well. And I can plug in the bond payments, and I can plug in the bond amount, and I can plug in the discount rate, and I can get the present value of a bond. We're going to be looking at chapter 11 and 12. Let's go back to chapter 11. Chapter 11 really is liabilities, bonds payable. It will talk about bond issued at face amount, discount, and a premium. So it's going to be issued at a discount if the market rate's higher than yours. It would be issued at a premium if the market rate is lower than yours. And then how do you report this? These are some fairly difficult accounting, especially when you're having to amortize the bonds and you either have to amortize a premium or amortize a discount. And then chapter 12 is just talking about stock and about the corporation and about dividends. There are three important dates dealing with dividends that as an investor you should know. First is the declaration date. That's a date that the board of directors said, we've got enough cash flow, we know what our earnings are, so we're going to give back some of our earnings to our shareholders in dividends, in cash dividends. And so the date of declaration is the date that they are obligated to actually pay the dividends. The record date is that decides who gets the dividend. And so whoever owns the stock at the end of that day gets the dividend. And if you sell that stock the next day, you still get the dividend. If you sell that stock the day before the record date, whoever owns it on the record date gets the dividend. And the payment date, of course, is when you get paid. Treasury stock is when a company goes out to the market and, just like you and I, buys or sells their own stock. This doesn't involve their initial selling of the stock. This involves them actually buying their own stock. For instance, maybe they think the stock is undervalued, so they'll spend some of their cash to buy the stock. Stock goes up, and then they sell, and they make a profit on their sell. So those are the two chapters. We have the problem set of, again, which is 50 points, and this should be fairly easy. And as long as you're willing to spend the time, you should get a pretty good grade on that. And then we have the comprehensive problem. And the comprehensive problem, of course, is going to deal with, let's start the assignment now. And so you're going to get a spreadsheet here. You're going to go and let's look at part 8. And you would have had to complete the first 7 parts. So this is the third part of this comprehensive problem. There'll be a spreadsheet on part 8 that you will use to prepare. Let's see, where is that spreadsheet? So part 9, you'll be using the attached spreadsheet for part 2. Post the entries to your general ledger. If the amount box does not require an entry, leave it blank. And here, of course, you just go ahead and put in fees, and then you put in expenses. So this is the salary expense, usually is first because it's larger. And then you have the rent expense is usually larger. I want to put in the larger expenses first, supply expense, utilities expense, et cetera, et cetera. And then, of course, you can check your work. Well, I guess utilities expense, it would be depreciation expense. Anyway, you should pretty much have the answers here and know whether what you have is correct or not. When you're through, you just submit assignments for grading. So that really is for Module 6. Again, you're continuing on the problem that you've submitted and worked on for a while. And now at the end of this week, you'll be 3/4 of the way through and well on your way to finishing this course.